Good evening, it's Doc from OnTheMoneyOptions.com. It is November 19th, Monday evening. This is our technical analysis session. We had a pretty wild day in the market today. The SPX was down about 1.66%. A lot of volatility's come into the market, so we can take a look and see what is happening here and whether or not there's enough technical damage to warrant further downside. Just want to take a brief look at the sector analysis. I know I put this on the website every week, but I thought I'd just touch base here and look at it. On the absolute basis, you can see that the offensive sectors were all down along with the S&P 500. Over on the right-hand side of the chart are the more defensive sectors, and they performed much better. But the overall market was down about 3.6% during this period of time. Looking at the relative chart, you can see again that the defensive sectors are all performing much better than the offensive sectors. With the exception of energy, it's still down. It's still getting kicked around with the oil prices, but I think this is probably close to a bottom at this point in time. Moving to the New York Stock Exchange Bullish Percent indicator, you can see that we're currently at 40.11. This means that only 40% of the stocks are on point and figure buy signals. What is concerning to me is this long line of O's here. We have failed to come back and penetrate through the 50% level. This is a low pull formation, and this suggests that if we don't move back above this, we may see a more downside in this market. This slide is the high-lows for each of the major asset classes. This is the S&P 500. This is small caps, mid caps, and the NASDAQ. The S&P 500's recovered a little bit, but as you can see, the small, mid, and NASDAQ are all down. So this is still showing a fair amount of weakness in the market. This slide is looking at the SPY. This is my relative strength analysis. That it does concern me some. You can see the red arrow here as we penetrated through the 50 level on the RSI last month. Actually, we've come down, tested the 30 level, moved up, and then repelled off the 50 and moved back down. This suggests to me that you're going to see more downside in the market. This chart's the New York Stock Exchange advanced decline. If you look in the thumbnail of it on the right-hand side, you can see that we tried to move up a little bit late Friday. And then today we've resumed that downward move in the advanced decline line. This is a cumulative chart, so this is accumulating the advancing stocks and the declining stocks every day. So as you can see, we've moved down to the lower side of the channel. This next chart is my rate of change. I watch this very closely. As you can see from the thumbnail on the right-hand side, we are very close to zero. We're at 0.29. This chart, if it moves below zero and stays there any length of time, as you can see from these other three instances, that we see generally more downside in the market. So I'll be watching this very close over the next few days. This is the CBOE options PutCall Ratio. The chart here at the bottom indicates that we're beginning to trend up on the PutCall equity indicator ratio, and as you can see, we've moved down here into the extreme pessimistic area. So you're seeing a lot of puts being bought and a lot of protection laid into the market. This chart is the Russell 2000 compared relative to the S&P 500, and as you can see, we moved down about 1/3% today. What's important to me is that looking over the past few months, since July, you can see that we've put in a series of lower lows, which is suggesting to me that there's still a lot of risk that's coming out of the market. This chart is the S&P equal weighted index relative to the SPX. In the equal weight index, every single stock in the 500 S&P 500 has the same amount of weight in this index. This shows participation, and it appears to me that from this that you're seeing a broadening participation in the S&P 500 now. This chart's looking at our VIX. We have it bound in a Keltner channel, looking at a 2 standard deviation band. And as you can see, it has made a pretty sharp move higher and has stayed up in the 20 region. This suggests to me that there's a lot of expected volatility coming in. And because of that, what's important for me is I want to see what is happening in the long-term VIX term structure to give us some indication if this is going to persist and become worse. This is a terrible chart from the CBOE, so I want to call your attention to this column right here. This is the current cash index that was today on the VIX. This goes all the way out to 18 December 2020. What you'll notice that every one of them are 20 point something. So what we're looking at is a VIX index right now that is extremely flat out until December 2020. That suggests to me that maybe this is not a problem that's going to get bigger as we go along. This next chart is looking at the correlation of the TLT to the S&P 500. And as you can see, here's the active part of the chart here. You can see that there's absolutely no correlation right now to the activity of the S&P 500 and the TLT. And you look back here in the past, once they diverged and it's negatively correlated, you've seen more downside in the market. So we'll watch this. This next chart shows the TNX. This is the 10-year Treasury note. And as you can see from the last few days that the actual TNX or 10-year Treasury yield has gone down. It's at 30.57, which means that the Treasury 10-year yield is at 3.057. And this would suggest to me that there is some money crowding into bonds now. This shows the relationship between the equal weight consumer staples and the equal weight consumer discretionary. When consumer discretionary is outperforming, that's indicative of the blue line here. That suggests that we're in an offensive mode. What you see here on the right hand side is that we've hooked up and are beginning to move up. I'm thinking that this is going to indicate a change and you're going to see more outperformance by the staples. This last chart's a little bit hard to see. It looks like a plate of spaghetti, but I wanted to show it to you. I'll try to explain it. I don't see anything really challenging here, but what this chart does is it talks about the sequence of change. And as you can see in the sequence of change, that bonds typically peak first. And then on the heels of the bonds peaking, the S&P 500 peaks. Later on, before we see a real big move down or maybe an end of a down cycle, the commodities will peak last. So looking at this at the right-hand side of the chart, I don't see anything that suggests that there's any peaks. We may see that this is a peak on the S&P 500, but it doesn't seem to match up with what we know is how the market generally changes from a bullish market to a bearish market. So right now we're sort of in a holding pattern. I think it's important to be very cautious here. Keep as much as you can hedged and be ready for something to happen in the market either way without much notice. So anyway, this is Doc saying stay hedged, and I'll talk to you soon.